Enphase Energy is down by almost 35% over the past year, and currently they're trading very near their 52-week low. The company specializes in manufacturing solar microinverters, battery energy storage, and electric vehicle charging stations. And with the increased sentiment to change everything gas-powered to electric power, this company has enormous headroom. And so today we will figure out whether you should buy the company right now for a great return, or whether you should wait for it to drop even lower. Now jumping straight to our stock screen, we can see that Enphase currently doesn't pay out any dividends. And this actually makes me quite happy, as they are quite a new company. They entered the market in 2012, and so they still need to direct a lot of their free cash flow into things like innovation. Now moving to the 9-pillar analysis, we can see that 3 pillars are currently sitting in the red, so the company gets a rating of 5 out of 8. The 5-year price to earnings ratio is currently sitting at 126.15, and the price to free cash flow is sitting at almost 30. Now if we have a closer look at the PE ratio, we can see that currently it's actually sitting even higher at 162.16, which means that investors are paying $162 for every dollar of Enphase's earnings, which to me is very, very expensive. Now if we have a look at the price to free cash flow, we can see that that is actually lower than the 5-year average, sitting at 17.44. And as all of you know, I'd much rather the price to free cash flow to be lower than the PE ratio, as the free cash flow is essentially the blood of company. Now looking at the other metrics, we can see that Enphase has been in the double-digit growth, revenue growing at almost 25%, free cash flow growing at 58%, and net income growing at 17.87%. Every single year over the past 5 years. Their profit margin is currently sitting at 41.65, but if we have a look closer, we can see that that as well has been increasing at a rate of 6.11%. So that is a great starter point for exponential growth. Now regarding their decreasing shares outstanding, they have been increasing them at a rate of 0.82, which doesn't bother me at all. And their long-term liabilities over the 5-year free cash flow negative dividends is sitting at 0.74, which means that they can pay off all their long-term liabilities in about 3 to 4 years, which is phenomenal. But now let's calculate their intrinsic value. So first let's move to the Grams formula revised, where we will take the 5-year earnings growth estimate sitting at 36.75% yearly and get an intrinsic value of $116.34, which is almost 40% higher than the current trading price. Now for the second valuation model, we take the free cash flow of the company and calculate the forward growth of 26.7%. We plug in a discount rate at 12.12% and get an intrinsic value of $121.59, which is again higher than the current trading price. And finally, we will also compare Enphase to one of its competitors, MKS Instruments, and we will get an intrinsic value of $111.11, again higher than the current trading price. Now finally, we will skip the dividend discount model, as Enphase doesn't pay out any dividends, and we will arrive straight to the ultimate valuation, where we will average out the 3 valuations and get an intrinsic value of $116.35, which is 63% higher than the current trading price. And so with a margin of safety of 30%, we would still get an acceptable buy price at $81.44. And so yes, even though Enphase is currently trading quite expensive, I do believe that they will go up in price a lot in the next few years. It is certainly a slightly riskier investment, but the riskier investments always have the potential to bring even more return. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.